Hello, and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, if you or someone close to you owns high value, tangible assets, protecting them isn't just smart, it's essential. Today's guest specializes in securing your prized possessions. What is our topic today? Well, it is the three questions high net worth clients should ask about protecting their tangible assets. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. On today's episode, we're focusing on safeguarding your valuable assets. We're joined by Dallas, Texas-based Yadira.anzueto. Yadira is a certified advisor of personal insurance, and she's a vice president and family office advisor at Lockton. Yadira is here to assist us in addressing the three questions high net worth clients should ask about protecting their tangible assets. Yadira, not exactly the setting that we had. One of the first times we had coffee back in Dallas, but it's great to see you again. Really appreciate you making time for us today. It's great to see you.
Yeah, good to see you too, Wayne. Thank you so much for inviting me onto your podcast.
Yeah, it's great to have you here. Now, I will say this is an opinion, but your expertise in the high net worth insurance space is invaluable. And I know you're respected by your peers around the country. You have clients, I know for sure, lots of clients in the Texas area and California. You're licensed in both states. I think you work with clients outside of Texas and California as well, correct?
Correct. I'm licensed in all 50 states, and part of Lockton's capabilities is we can work with clients anywhere in the world, actually.
Well, I'm so glad that, to know you, and you're an incredible resource for me. Before we get to our three questions, I think it would be a good idea just to bring everybody up to speed. If you could really outline, what your role is and why it's particularly important for high net worth individuals to have a more specialized approach to ensuring their tangible assets. I mean, tangible assets, I'm talking about things that you can actually see and touch, not, you know, something intangible. So maybe you could just give us the overview on what you do and the type of work that clients you work with.
Yeah, so I am primarily a property and casualty high net worth broker. And what that means is, like you mentioned, I do help families with securing coverage for their tangible assets. Those are things that we can touch. Think high value homes, high value autos, collections such as jewelry or fine art, umbrella coverage. Liability management is a very big portion of what I do for clients. But even think toys, recreational vehicles, watercraft, mega yacht, aircraft, any of these things that our families may own personally, is what I help with. And my job is really to come in, meet with a family and get to know them, get to know about their lifestyle and where their current insurance program is today. And what I do is I help to identify gaps in their coverage that they may not be aware of, and I find solutions for them. I would say today that 50% of my business is working with high net worth, ultra high net worth clients, and the other 50% of that is family offices. And both areas of insurance bring a level of complexity that a standard market such as Allstate or State Farm really are not set up to address. They're very good in their space, but at a certain level of wealth, or as a client accumulates assets, tangible assets, they need a different level of coverage. And so a lot of the conversations we have are around asset protection and liability management. And what we find sometimes is that sometimes families just don't know. Think about first generation wealth, where they've slowly been growing over time. And a lot of the times they're small business owners. And so they're not really paying attention to the personal insurance. And we get into a situation where if they're not educated on what else is out there in the market, they may be overpaying to be underinsured, if you will. So that's essentially what I do. And it also highlights the need for what I do because, again, you ask a family, especially first generation wealth, about when their renewals are, how often they talk to their broker. And a lot of them will honestly give you a blank stare and say, I pay my policies every year and it's fine. And the next follow-up question is, have you ever had a claim? And they say no. So maybe it's not fine. And maybe we should talk about potential gaps. There's a lot of different things that families do for planning purposes as they start to grow in their wealth. And those are not addressed within a standard policy. And so we'll look at things like, are your properties or assets owned in the name of a trust or an LLC? Do you have the right umbrella policy limits? And so we take them through this whole process. And I believe that's why it's essential for a successful family to work with a broker like us.
Yeah, you just brought something up about, I think, really well, is that the importance of what I call a discovery process,
Mhm.
where, I mean, I remember when I was working back in Canada, and I would hear it once in a while down here in the US and say, I'm a client, I'll be in a meeting with a client and their phone will ring and they'll say, I'm with my investment guy. And in reality, that's just a sliver almost of what we overall do. We're doing very detailed wealth management planning with a client. We're talking about their tax planning, their estate planning. We're obviously talking about risk management, which is kind of where you do what I consider you in that the risk management space, right? There's other factors. Maybe talking about real estate. It could be financing. I got cross-border clients that may have immigration concerns. We talk about cash flow, so many different things. And so in your space, it's kind of the same thing. You need to kind of look under all the stones, not just focus on one area. So that's something I picked up from you, and when we were talking, I guess it was a year and a
I think
half.
it's important to keep in mind that it is overall risk management. You won't
Yes.
call us and get a
Right.
quote on the phone or place an order over the phone, if you will. It's overall holistic risk management. And the way that I explain that to clients is I will say, look, you've been extremely sophisticated and savvy about your planning. Good job. You're working with a comprehensive wealth team. You're working with an estate planning team, maybe a tax advisor. And so I come in as the tangible assets piece to really protect the plan that you've put together. We're going to be the first line of defense for all of the other planning that you've done.
Like you're
So
putting a Teflon ball around everything that they own, basically.
that's right.
Yeah. Now, I'll say this, and I've heard this before, and I wanted to bring it up with you. There's this misconception out there that insurance coverage automatically adjusts for inflation or market value changes. Now, as you're more than aware, value items like, value items like art, antiques, jewelry can either appreciate or depreciate. And without regular appraisals, insurance might not reflect the current value, and that could lead to either under or over insurance. How do you address that?
Well, so when you talk about valuation of assets, my mind automatically goes to two different places, or maybe three even, but I think about property valuation or what the accurate replacement cost is of properties these days,
Hmm.
or also collections like art and jewelry. Now, I would say that I'll give an example. After COVID, what happened is the cost to rebuild per square foot skyrocketed. It had to do with a few different factors, things like access to labor, access to building materials. Then the building materials that were coming over from overseas maybe had tariffs attached to it that was causing the cost to go up.
That
And
isn't
so
going to change anytime soon. The
well, yeah,
tariff part,
kind
we
of
won't
political
go into
conversation,
that.
but there's a lot going on there. And so I'll attach this piece to an example. In October of 2019, there was a tornado that blew through Dallas. And it happened right before I moved here. But what happened is it was a very affluent area. And maybe half of the homeowners were with a direct market like Safeco or State Farm seemed to be a common one. And the other half were with high net worth comprehensive carriers. And what we saw is that with the clients that were with a high net worth broker, claims, although it was still a difficult time, claims were settled quickly, payouts were received, and construction started right away if the client decided to build again. With the other half that were with direct markets, and I don't only want to pick on State Farm, but I spent 10 years there, so I always default to them. What they learned is, hey, we don't have the right replacement cost limits on our policy. So they went to these carriers and said, I was underinsured. I had no idea. But it works differently. And this is one of the other key areas that high net worth clients should pay attention to, because you're going to a direct captive agent where the onus does not fall on the carrier to make sure you're adequately protected. The onus falls on you. Whereas on the broker side, it is our responsibility to advise you correctly and make sure it gets done correctly. But I do insure quite a bit of construction risk families, and so they're in the business of construction. And when we talk about properly setting the homeowner's limit to what it would cost to rebuild their home, a lot of the times they think, well, that number is way too high. I could rebuild my home for half that. Or it seems like it's overinflated. And so we walk them through how we come up with our replacement cost estimate. And one thing to keep in mind that is important is, even if you are a construction family, for instance, I'll use that example. It's very common here in Texas. The insurance carrier will not get the same deal, if you will, on the cost per square foot. Where we're getting this number is from a few different carriers. I would say a lot of different carriers that are compiling or throwing these numbers in of what it's currently costing them to rebuild a home that's like and kind to yours in that area. And so sometimes the limit may look a little high, but we also will safeguard that with, if the family decides to move forward, the carrier comes out to the property and they do an on-site inspection to make sure that the broker's not over-insuring or under-insuring the property. So I think there's a lot of due diligence that is done in that space, because at the time of loss, carriers that I work with, like Chubb and Pure and AIG, offer what we call either guaranteed replacement cost or 200% replacement cost extension, meaning that there will always be enough money to rebuild if that's what you'd like. Now, in the collection space for fine art or jewelry, there's a couple different things to keep in mind. One, if a jewelry piece is over 100,000 in value, an inspection should be done every 3 to 5 years. If a fine art piece, a painting, it has a value of $250,000 or more, an appraisal is required every 3 to 5 years. And the reason for that is because these fine art or collections policies come with what we call 150% market value appreciation, because these pieces tend to go up and down in value. So if they go down, no harm, no foul, limits will stay the same. But if they go up and we didn't update the limit on the policy, the client's still protected up to 50% more on the value.
So who initiates? That's a really good point about the recurring, the sort of a review. We'll call it a review for the sake of the discussion, which, you know, my clients are familiar with me because I pester them probably every 3 or 4 months to schedule a review meeting with me. So what you're saying is that every 3 to 5 years, there has to be a review of the value of these high valued assets. Now, is this something that you're going to initiate? Like, where's the accountability here? Because people's lives are so busy, you know. Like, is this something where you have a list of all these asset values and you're going to the client and saying, hey, we got to get your property revalued? Or how does that all work?
Yeah, that's a good question. I mean, we like to present ourselves as concierge level services when it comes to insurance.
Mm-hmm.
So yes, that falls on us. We regularly conduct annual review meetings with our clients. Our systems are notated to let us know, hey, an appraisal is expiring soon. You might want to ask that. If the account is more complex and client is in asset accumulation phase and they're buying boats and houses all the time, we may even have a 3-month cadence with the family where we meet quarterly, and we will have it notated in our system. And we recognize people are busy and it's our job to look over their holistic risk management. So when it comes to locked in, I would say that falls on our plate and not the client's.
Excellent. Okay, well, we're here today to discuss the 3 questions high net worth clients should ask about protecting their tangible assets. And again, these questions are questions that Yadira typically addresses while advising high net worth clients. So Yadira, back at you with some really challenging questions for you today. Okay, question number 1. What is the term recommended limits? Why is the term, pardon me, recommended limits so much higher than my current policy limits. I'm sure you must get a lot of that and having to explain again, why are these numbers so much bigger than what I expected?
Yeah, so we just touched on that when it came to the home portion, right? And typically in the way that I present the proposal to the client, the properties always come first, and that's the first thing that stands out. They were with State Farm or Allstate, and they were insured for $800,000 on their property.
Mm-hmm.
Property 5,000 square feet, and they live in Highland Park, Texas. It's a very affluent area here in Texas, or Brentwood in California. And they cannot understand why I have quoted the same property that's insured for 800,000 for 3 million or 5 million. And they say, where did you get these numbers? And again, we do this replacement cost estimate report that tells us where we should be coming in. And we explain, first of all, now based on my experience with a standard market, their replacement cost estimate, cost per square foot is off, but also their rating factors are off. So that's when I go back to my comment earlier where I say sometimes they're overpaying to be underinsured. And it happens quite a bit where they may have an $800,000 policy. I'm recommending that we increase it to 3 million, but the premium's not that much higher than what they're paying today. And they can see that we've doubled or more than doubled in coverage, but that premium went up 30 or 40%. So for the amount of coverage that you're getting, you're not having to pay so much more out of pocket. And again, we go through it step by step, and we let them know anytime that we see a policy coming from a direct carrier, we are automatically assuming, although we should not assume, which is why we're diligent about it, is that you're grossly underinsured. And let me explain why. And let me show you what other homeowners in your area are currently paying to have similar coverage. And so it's more about the education piece when it comes to this. We go through in detail, and again, we explain the state of the market and how things are going, but it's not that it's so much higher than what their current limits are, it's that they were grossly underinsured most of the time.
You know, as you know, you're from California, lived in the valley for part of your life, and so you know the area. But we had a what was called the Wolseley fire back here.
I remember I was there.
Yeah, I'm going to share a comment with you. I don't know if I mentioned this to you before. I'm going to share a comment with you, and I'm interested in your response. So the comment is this I heard was, I would rather have my house burned to the ground, right down to the pad, than have the outside structure remain standing and everything inside be destroyed. Because if I have the first outcome, I'm going to have my claim solved much quicker. I actually have heard that people say that. What's your response to that? Just, I'm curious. I know.
Yeah. Well, there's a couple of things. So it's funny, I'm laughing because I'm thinking back 24 years ago when I started in the industry and I was in class to get my PNC license.
Right.
And one of the things that the instructor kept hammering into us as we were preparing to take the state test was, when in doubt, burn it down. When in doubt, burn it down. You want to,
What?
if you're not sure if there's coverage, burn it down. Fire is always covered, right? And so that's the first thing that I think about. So I know where that comment stems from. There was another article recently that one of our partners shared internally is there's also the thought like I would rather the home burn to the ground because having to clean up smoke damage and all of the other damage that comes from fire being in the area can really cause health harm to your health actually. And it's not as easy or as straightforward as we think. Is we're insuring it for property and casualty, but what about the secondary harm, the pulmonary issues that clients then have to deal with, or soot or smoke damage is never truly cleaned up. So there's a lot that goes with that. But yeah, no,
Yeah.
I've heard that as well.
I guess I should have probably, that comment came from the Wolseley fire. We all know, we just saw here a little while ago the horrible Palisades fire
Yeah.
and the fire out in Altadena as
Yeah.
well.
environment.
And one of the big issues they had was the cleanup of and it's just so huge, immense. Yadira, it's unbelievable.
It's unbelievable.
It
Yeah.
really, but the health risks that they were talking about of all these properties and the toxic waste related to the cleanup was anyway, it's just one of the most horrible things I've ever seen.
Yeah.
Um,
The environmental hazards that come because of it. Right.
uh, okay, so I want to go on to question number two. Yadira, I'm really happy you're here with us today. Question number two. I own my home inside of my family trust. Should I list the family trust as an additional insured? This is really where you come into. This is a very technical question here, so please take it away.
Yep. It's a technical question, and I will say it's also one that I see not done correctly on maybe 90% of the policies that I come across. And yes, if you retitle a home or any tangible asset into the name of a trust or an LLC, be it a home, a watercraft, aircraft, anything, it needs to be added as additional insured. It is a technical question because it's such an easy thing to fix. It's typically a free endorsement or a $25 annual endorsement to add this additional insured. But if that step is not followed through on, you've just caused a huge gap in coverage. And I'll explain why. So, husband and wife, they are people, they walk away, they can cause liability issues anywhere they go, but the home doesn't walk away, right? And so we always say, assets or entities don't cause liability issues, the people do. However, in the event of a liability suit, I was just talking to a family office earlier today, a very common example. Husband and wife host a dinner party, they serve alcohol. Maybe one of their guests has a little too much to drink, drives off, and gets into an accident and injures another party. The first thing that that officer will ask is, where were you? Were you drinking? And who served the alcohol? And immediately after that, the attorney comes and will list the party hosts, right? Husband and wife that were hosting this party, the person that was involved in the accident, and then quickly they realize that the home where they were for this event is named in the name of a trust or an LLC, and they will add the entity to the suit as well. Now, husband and wife or insured and spouse, they have coverage on the policy because the policy is written in their name, but the entity is sitting there uninsured with no layer of protection. And so it's, again, it's easy, but it's technical. And if it's not followed through on, it's a huge gap in coverage.
Of all the things that we've talked about so far, the folks listening in today, pay very close attention to what you dear just said. Um, I come from Canada, just as an aside, and when I came down here, one of the first things that someone ever mentioned to me was, "Do you have an umbrella insurance?" You would have loved my response.
Oh, I know your response. You
What's
know,
that?
yeah, exactly. And I tell everybody this, part of my value proposition is that I am a US based broker, but I work with families from all over the world. And I tell them, you want to look at liability exposure or liability management from the US lens because we're extremely litigious in this country. But I've had families from Latin America, from Asia, and they say, why would anybody want to sue me?
Exactly. Well, same coming from Canada. Canada is not
I
exactly the
would
most
say,
litigious
yeah,
place in
yeah,
the world either.
exactly.
And you know, all a property casualty, probably not property, probably I'll restart over again. All a personal injury attorney needs to hear is I got hit by a car or I was at someone's house and I fell down the stairs because the railing broke or
Right, right.
slip and fall. And the next question the attorney will ask, and you know this better than me, is was there any insurance?
Yeah, yeah,
And I can tell you right now, I've had someone who was in the verge of hiring me who can't get themselves into some, a litigious issue, and they didn't have coverage. and they wrote a rather significant check as a result of that.
That pains me. That absolutely pains me. And I go through this
And you think
exercise.
about the cost of umbrella insurance on itself, like it's
Yeah,
a rounding error on a, it's literally a rounding error on a balance sheet.
it makes total sense. And talk about protecting the entire plan. I will talk to clients, listen, when determining the right umbrella limit, think of these 5 factors. It is the secret formula, in my opinion, but think through tangible assets that you own, liquid assets like money in the bank, retirement accounts, investable accounts, as well as the potential future earnings. These 5 factors make up your
Future
total.
earnings, exactly right. No one
Well,
ever
and that's
thinks
part
about
of the
that.
conversation where I normally will include the wealth manager because they have a better projection for us. But it takes thinking through all of those scenarios because even if you don't have 5 million in the bank liquid, but you're involved in a suit where you're not insured and have to go call Wayne and liquidate one of your accounts and say, I need to pay out the suit. When a $5 million umbrella could cost you as low as $1,500 a year,
Pennies on the dollars.
yeah,
Penny
it
on the
makes
dollar.
sense. Yeah.
Literally. Okay, Yadira. Just a great resource here for our audience here. I'm really glad you joined us. Okay, we're going to get to our third and final question. Again, if you are a owner of tangible assets, pay attention. I thought my art collection was covered by my homeowner's policy. Why do I need separate coverage?
Yeah, that's a really good question. The reason that you need separate coverage has a couple of different responses. Number one, every homeowner's policy, even with a high net worth carrier, has very low set sublimits for things like jewelry and art, firearms, things like that. And so if you have any type of collection, the special sublimit of 5,000 for jewelry or 1,500 for art just won't suffice. And in addition to it being such a low sublimit, if there was a claim, it would be subject to the policy deductible. So pretty much a wash when you think about losing a piece of notable value. But then when we quote it under a separate collections policy, these policies, at least in our space, the high net worth space, they come with a zero policy deductible. They come with worldwide coverage. And things like mysterious disappearance is always included. And so there's a lot of policy features that would never be found on a homeowner's policy. And that's why we have to insure them separately. The last comment that I would make on a collections policy is also to maybe think about insurance a little bit differently than you've always thought of it. Most people think of collections coverage covering assets like jewelry and fine arts, but we can insure many different types of collections.
You're leading me into my segue, my follow-up question, and it goes to my own guitar collection.
Yeah.
And so how if again this is something I've been struggling with between you and me is how do I like how do you value guitars? Well, you pay a few $1,000s each for guitars at Guitar Center, for example. They start to add up when you start, I went through a phase where I was buying guitars fairly frequently. That's kind of petered out a bit, but my son's playing them more than I am these days, truth be told. And he's pretty good, by the way, on that note. But all that said, how do you how you determine what a Gibson or a Fender Stratocaster or Telecaster or a Gresh White Falcon or and oh, how do you determine how to insure them?
Yeah. So, first thing is asking the client, how much do you think your collection is worth? A lot of clients, especially if they're very interested in a certain area, they have a general idea of how much it would cost to replace the collection or each individual piece.
So is it on
But they
replacement cost, you dear, more so than what they're currently worth? Like, how do you quantify that?
Yeah, so no, it's not, it is replacement cost for each piece. A lot of the times, if you have a very large collection, it could be quite burdensome to go through every single piece and go research how much they would be worth. So
Exactly.
we have the option to either connect you with one of our resources that can come in and give you what we call an insurance appraisal, where it's not really an appraisal that could be used if you wanted to sell a piece, but they generally tell you what the value of each guitar is or the cumulative value. It is at the client's expense, but it's a good idea with larger collections if an expert comes in and tells you, this is what I think this guitar is going for current day today, or that piece. And so that's a way to do it. Another way to do it is sometimes clients will say, I don't really want to bother. I know that I have about 100,000 in guitars. Can we write a blanket limit? Meaning nothing's specifically scheduled out individually. It's just a blanket limit policy. So yes, we can do that. So just think as an example, if somebody came to your home and broke in and swiped every single guitar,
Right.
would write out a check for $100,000. But you know, with larger or more unique pieces, we recommend an appraisal.
But just like you said, if we took, I don't know, is it eight, maybe eight or nine? I could just basically, this is what each one of those are worth, and you just insure it for that amount.
Yeah, as long as it's not over 250,000,
It won't be. No.
then
Very good.
then really we just take your word for it. Obviously, you may have receipts or some documentation in the event of a loss, but it's not really necessary. I think this brings up a really good point is there actually is a lot of fraud in this space of insurance. And so as a broker, we do quite a bit of due diligence in getting to know our clients. That's an important piece of it. Of course, we want to work with new clients. Of course, we want to, bring on new families, but it has to be a good fit and there has to be a lot of due diligence on both sides. You should get to know Lockton and our capabilities, and we will definitely want to get to know you. That doesn't happen too much only because we work with advisors like you, advisors that we've built relationships with over time, where we know it's a reputable firm, a reputable practice, and that their clients have been fully vetted. But I mean, it's a part of insurance that does see a lot of fraud, actually.
Well, again, I'm really glad you took the time out of your busy schedule. I know we probably scheduled and rescheduled this recording episode at least a couple times. So thank you again for making time for us. And before we wrap up, there's one other thing I wanted to talk about. And now I'd say in California and maybe Florida, this is a topic that I think is being addressed more and more, and that is um, the feasibility of self-insurance. I get, specifically the feeling that high net worth families in particular believe self-insuring valuable property is a better option because of rising premiums. So from what I can see, I see significant financial and logistical risks, especially from the standpoint of the work and services, the ability, not having anybody to help with loss, with loss prevention, making claims or having claim support. So I just want to get your thoughts, especially now with, I would think you're going to be talking to an audience here in California or in Florida, talking to them about the limitations. Again, maybe I'm leading the witness here, but what are your thoughts about self-insurance? Basically saying, I'm going to go it alone.
It's interesting. I will say that I don't come across that as much as you would think. A lot of our clients, regardless of net worth or liquidity, are looking to transfer risk. They want to know that they're protected should the worst happen, meaning catastrophic loss. So I don't see it as much. There are situations, and there was an article that was written about a year ago or a year and a half ago, and it went pretty viral. And it was from a very popular finance guru, I'll say, where she was complaining about premiums in Florida for her very, very high-end condo and how she had decided to self-insure. Well, this condominium was valued at about $60 million, and her premium was almost $100,000, which I know is a lot of money, and it doesn't matter what the net worth. Everybody's price sensitive at some point if they don't see a true value. Now, she writes about how she's not going to dump $100,000 into this black hole year over year to protect her condominium, but I guess my thoughts on that is it depends on how risky you're willing to get. Would it really be worth it? She talks about how it's her primary condominium. She loves this place. It's her sanctuary. She always comes back here because she loves this area of the country. But if you lose a $60 million condo, walled in because she's responsible for all the contents and the infrastructure inside of the unit, would you be happy about writing a check for 60 million to get it back to where it was before? I think it just depends on the client. And, where I really get what it just really breaks my heart is when I see clients that are forced to self-insure because there's no other coverage options. And
Right.
we see that in California quite a bit, but I don't run into clients very often that want to self-insure. Not at all.
You brought up that number 100,000, and we do as we do a lot of forecasting and analysis for our clients. And if there's one thing I worry about, and I don't have a sense of from the real estate side. So when we do forecasting and analysis, some cases we're seeing the projected cost of property insurance. I'm going to speak specifically of California. Next decade, Yadira, next decade, the 2030s. I'm seeing projections for property and casualty in the $100,000 a year range, potentially, depending on how, if it really depends on the state and the local carriers and where we see premiums heading. But it's not, to me, I can see by, the year 2035, 2036, 2037, and we're talking 10 years out from now, people paying 60, 70, $80,000 a year, not to insure a $60 million home, but I'm
Right,
talking to insure a $2.5 million home in
right.
Westlake Village or Encino or Tarzana or Sherman Oaks. That's what really I find interesting, is how are people going to digest that? Those are significant numbers. So I must admit that one, that I think about that. I must admit, I know there's nothing we can't solve about it today, but it's something that if you're a resident of California, I think if you're working with a financial advisor, you should be preparing yourself, doing the forecasting and analysis to figure out, am I going to have the liquid resources? What's my spending rate going to look like if I have to spend $75,000 a year to get my home insured? Which
Yeah, it's not sustainable, and never did I think, I mean, based on the last 24 years, that our very high net worth clients would be priced out of buying a certain home because they either couldn't afford the insurance piece or didn't want to because it's just
That's the
ridiculous.
part that you just nailed, the last part. Didn't want to. So I asked myself, we have a whole, like this, think about the south side of the San Fernando Valley, all the way from Sherman Oaks
Yep,
out past Calabasas here out into the Canal Valley. There's a lot of houses there worth 2.5 to 3, $4 million. That's not an unusual. And the folks living in those houses don't think of themselves as anything, just regular folks, right?
successful individuals, right?
Right. So all of a sudden they wake up one morning and find my renewal, like think 10 years from now, which you and I both know 10 years from now isn't going to take that long. That's going to be, I'm fascinated to see how this unfolds. I must admit, it's probably,
Yeah, and every year we get, sometimes we'll get comments from our carrier partners that will say, oh, we think there may be a softening in the market in the next 18 months. That's depending on how many named storms we have in the next 12 months. Well, they're projecting for 20, but we get 37 named storms. And so there's no softening in the market. And these things are just becoming more and more frequent. So where do we,
I'm fascinated. To me, where I think it goes, and again, I'm not a real estate professional, and you and I both know many who are far more informed than I am. We are. But I think to myself, what will happen to property values? What will happen if all of a sudden it's going to, I see personally, I don't know how property values will continue to grow if all of a sudden people are en masse are paying like I said, $75,000 a year for property insurance. It's going to be interesting. It's fascinating for me anyway.
Yep.
Exciting news for you, but fascinating. You know what, Yadira, I love having you with me. I've been wanting to have this podcast. I wanted to have you on for so long. Thank you for making time for us again. Just, for those watching, on the website, we have your information below you on your screen. People can see it with their own eyes. But for those listening in, could you share what is the best way for them to contact you? Because I imagine they're going to want to probably have a conversation.
Sure. Yeah, I would welcome it. You can email me direct at yadira.anzueto@lockton.com. My mobile number, I'm very old school. Call me direct, 661-618-0727. And you can find me on LinkedIn or on our company website. So thank you so much for having me.
Oh, I loved having you, Yadira. You take care of yourself, Yadira. Thank you so much. Yadira Anzueto is a certified advisor of personal insurance, and she's a vice president and family office advisor at Lockton. Yadira, thanks a lot. We'll see you soon.
Thank you. Have a good one.
I look forward to bringing you the Three Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification of when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.